Hello, hello. Welcome to the closing bell on the 26th of April for me in about midday. And today I am kicking off with the US bonds. I know they can be boring as hell, but I think we need to just look at the big picture and have a think about what's going on out there. Because GDP figures coming out in the US and, coming undershooting on growth, overshooting on inflation, PCE, deflator, that sort of thing. And that's just adding to the bad inflation readings we've been getting lately. We know US bonds under pressure. So really the whole story we've been playing with over the last 6 months is changing and quite rapidly. So we've got to be thinking about where the risks are and whether evasive action needs to be taken. So I just thought I'd start off with these US 2-year bonds, long term, just to give you that sense of where we're at. And the yields, we know with inflation flying, I mean, look at that pace of increase, just incredible, chasing down inflation. And, we've been looking at this the last 6 months thinking, oh, that's the high now. It probably will flip over into a downtrend in yields. So obviously just based on the moving averages, that 10-month exponential, 20-month simple, just for me is a pretty good um, sense of what's going on. You can see there when it's flipped over into downtrend, as I've shown you in the past, but just for new people, uh, pretty good in the past, hasn't it been? Since what, 1989? My data doesn't go back beyond that. But you can see when it does flip into downtrend, those yields, it at least gives you a pretty good heads up about what may be coming next. So until we do get the long-term trend shift down, it can keep heading higher, can't it? And it hasn't actually turned down. So it was getting so close. We've been watching it very closely. This last few months, like 6 months, we had the big rally in bonds. So that's the rally in bonds. Yields falling from about 5% down to sort of 4. Everyone getting excited. Interest rates are going to be cut soon. And that story is fading as inflation remains sticky. And with stocks rallying so strongly, when does these rates marching higher really start to kneecap the stock rally? And what we've got to think about is we're getting to a stage where things can change rapidly. So in the past, if we're looking at how things sold off, usually it would be something breaking after rates going higher. And, 2007, rates stayed high there around that 5% for about a year or more. And we had, as we know, all of the kerfuffle around the mortgages over there, the property market imploding, and that caused a big stock crash, and also rates fell. So there's the 2-year bond yield you can see crashing at that point. So that was falling yields, falling stocks. Similar in 2000, the crash in the tech stocks, of course. So again, falling yields, falling stocks. But back here in 95, we had this preemptive move in rates, which really surprised everyone. And rates really raced higher there. But when they turned down, that actually set off a big rally, wasn't it? 95 into 2000. That was a huge stock market rally. So this is just showing the 2-year bonds. And you can see over that period, it wasn't falling rates, falling stocks. It was falling rates, rising stocks. So, that's where you're asking yourself, in this period here, once things do actually turn down and we get the rates dropping, is that going to be on the back of, stocks then rallying, or will it be after something breaks and we get falling rates, falling stocks, as we've seen in sort of the last few instances going back a couple of decades? And, I guess I would say with inflation at the moment, they're really chasing it down, and it's not, the genie isn't back in the bottle yet. So they may need to chase it down further. And if growth is coming off the boil and inflation still is sticky, they're going to be in a rock and a hard place, that sort of stagflationary situation. So it's a bit different from this period here where they really were quite preemptive and really surprised the market with the rate rises that they did. You can see the huge sell-off. That is actually a sell-off in 2-year bonds with the yields going up. And, being preemptive, settled things down. Rates could then start falling and economy took off. And, everything was great. Stocks rising, rates falling, Goldilocks. But are we in that sort of a situation now? Maybe not. So things can change rapidly in a situation like this because it is late in the cycle, isn't it? You're going to say it's getting closer to a point like this. Got to be. But does it need one more wave before then turning down and having the next wave down? We know we're getting closer, but the way the technicals are right now is pretty negative. And on the 10 years especially, it's actually going to be a sell signal this month. So in these 2 years, the sell signal or the buy pivot on the yields was a couple of months ago. And then it's carried on, yields going higher and, getting back to this 5% level. What happens above 5%? Does it shoot through there? That would certainly surprise everyone, wouldn't it? So let's have a look at the 10 years quickly. So here's the 10-year yields, and I've been saying the last few weeks, how this month finishes up could end up making those bonds look pretty negative indeed. And we are shaping up for what would be a buy pivot in the yield. Remember, yields going higher means the price is going down. And so that's the one confusing thing about this chart, but it is the US 10-year bond yield chart over decades. So you can see yields trending higher from 2021, really flying higher there. We did get a nice bullish move over, late last year, but that's being reversed. And if we just go on the long-term trend, long-term trend still well and truly up. That 10-month exponential, nowhere near crossing the 20-month yet. And really, if we're looking at, as I've shown you before, just the structure of the trend, still very strong. We haven't seen that trend under threat. We really need to see yields going back below that level to say that this trend based on the waves is under threat. So, that's what, 3.3% or something. I don't know exactly what it is, but it's a long way down from where we are now. So, we're having this wave here, and now the buy pivot on those yields, does it need to trend higher again, take out that high? That would be unexpected. But either way, we're sort of looking at this still as long in the tooth, and that, if it does go for another wave, that's probably going to cause a lot of problem in stocks, commercial real estate, property, et cetera, et cetera. So we know we're sort of getting towards the end, and this rise in yields may be similar to what happened here, going into the 2007 peak, or 2007, 2008. And, then something breaks and all of a sudden rates are falling rapidly again. So it's that sort of situation. It's a really tough situation. I just want to point out that it's now pretty much negative on those bonds, especially at the end of this month. And it will remain negative until, we do get like a sell pivot in those yields, or what have you, or it's another rise and then finally turns down. But for the moment, you are just saying these bonds need to find their equilibrium level, and they're sort of out of balance at the moment, still rising, and inflation still a problem. So it's a development that you have to be aware of, because US stocks have been so damn strong over the last 6 months on the back of this story. So we've had this blast off rally, which caught me off guard. I didn't expect it, but I did, as you should know, turn bullish regardless, because of the buy signal, that monthly buy pivot. Back then, long-term trend was up. So, my hands were tied to say I could no longer be bearish and had to turn bullish. And then we got this big run. But as this interest rate story develops, we do have to be just, on, I guess, tenterhooks about the potential for things to turn down. So I'm just going to give you that, big picture. Everything's fine. Really, when you're looking at the momentum and et cetera, you can see, just looking at this is, decades of trading. And if we're looking at those long-term sort of trends, long-term trend definitely still up. God, I'd have to sell off a long way to change that. And just through here, I've just got really the slope, the red line, the slope of the 10-month exponential, the blue line, the slope of the 20-month. And, the best rallies occur while the 10-month exponential is above the 20-month. All right. And they're both in positive territory. So, really good runs can happen during that period. And, we're still in that state, aren't we? 10-month exponential slope, still well above the 20-month. It's still in a really bullish phase right now. And also the moving average convergence divergence. So that's just looking at the relationship between that 10-month and the 20-month. So 10-month exponential and 20-month simple. It's a custom MACD. So I've got the calculations in for that difference between how I look at things. And really, you can see that MACD still in positive territory with the MACD above its signal line still. So you can see when it's turned negative, it can just often be a good precursor to a negative period in stocks, either sideways or, sideways down. That was a big sell-off. This period here, big sell-off, lining up with when those MACD turns negative. So that still hasn't happened. So we really need to see the sell-off gather steam to the downside to get too worried. And that would be, failing back below the old high from 2021. And, then that's in the future. If that were to occur, then we'd be getting a little bit nervous about what's going on. You'd be seeing this flipping over to negative. You'd be seeing this flipping over to negative. And then you'd be, backing off, being too gung-ho about what's going on. But so that's the really big picture, is that it's, fine. But the weekly has turned negative just recently. So going shorter term, much noisier in the short term, And, when things are really positive and the MACD signal turns negative, so from up here, you sort of get that momentum shift to down, you can end up seeing, as you can see, a bit of a sell-off there, which happened months ago, prior to the buy signal there, and then bang, off it went to the upside. But when it's really strong, I mean, you get plenty of sort of signals that aren't necessarily great when it's in this sort of a state, slowly but steadily heading higher. It will sort of give you that negative momentum, which is what the MACD sort of tells you about. But stocks will just go sideways for a few months. Like here, stocks sideways for a few months. Then they kick positive again, bit of a rally. It never makes it easy in that shorter time frame. So I don't sort of sell stocks or run away. It's not that sort of an indicator. It's more to say, well, what state is it in? Is it in a bullish, really bullish state, monthly saying up, weekly saying up, staying up, which would be, as we've seen in this past however many months, right, where you've got everything sort of pointing up. And so when you've got that weekly all sort of saying yes, they're fine, weekly all saying yes. Then a few weeks ago, I told you, weekly sell pivot in place, watch out, momentum turns negative. So it's just saying, just be wary for the moment. We're not saying how far it's going to fall, but just that we'd like to see this turn positive, wherever it's going to turn positive, because it could go something like this, couldn't it? Before then turning positive. And, that could be a fabulous buy signal whenever that comes. So all I'm saying is that you look at the monthly, you get a sense of that big picture, all looking fine. And then you sort of go shorter term and say, well, is this a state in the market where I should be just buy? Or is it one where I should be a little bit more careful? And if I'd made money on this run, then I might be just taking a few profits and then just seeing what happens here. Because of where the interest rates are, the fact that this story we were told isn't coming true, of inflation just falling, rates about to drop, everything bullish again. So, there's a chance that this rally that we've seen in the last 6 months might be a bit of hot air. And it may need to have a bit of a balancing up period before deciding what to do next. So that, I guess, is the state of play just right now. It can all turn back bullish, really quick. As I've said, when you're in these really nice, strong trends, it can be a great buy signal on this weekly. When you do get the signal turning positive, especially after a big sell-off where it's all gone really negative, if we just look at all of these periods where that weekly MACD turns positive, you'll see that there's definitely some good rallies that ensue after you get that signal, even if it ends up turning down again. Nice big rally there. So it can be a great thing to watch, as you saw here, just the most recent one. Went positive there. That was pretty much the beginning of that nice big rally over the last 6 months. So that's really the state of play, is being aware of those 2-year bonds hitting 5%, 10 years, 3.7. How much higher do they need to go to start causing a bit of trouble for stocks? And the momentum right at the moment is negative on that weekly, but we haven't got the weekly trend down yet. So we're going to need to see more selling pressure before, adding to bearishness. At the moment, it's just more of a let's just wait and see here. If you've got some good profits, maybe take a few off the table. If you're exposed to interest rate sectors, based on the rally that's been going on. I've actually dumped, and for members of my services, we've gotten out of the interest rate sensitive stocks that we'd sort of jumped on a few months ago, because things are changing. So that's, I guess, the point for today, is to be aware of what's changing and how it can affect things going forward. All right, well, that's enough, I think, and I'll come back with more next week. Cheers.